right? How you should measure model trading volume, how you should model prices, right? And so I think we have been working on this unified framework that kind of tries to fit all of these pieces together.
Can you do the 1, 2, 3, 3, 2, 1?
Yeah, let's start in 1, 2, 3.
Everyone, welcome to the Sophron Network, the podcast where we cover industry insights with professors, industry experts, and also traders, people from the industry, those who are interested in financial markets. And we want to bring knowledge to the listeners so that they can get some insights that they can't get anywhere else. Today we're here with Johannes Muhle-Karbe, who's the head of mathematical finance at Imperial College. First, I want to introduce myself very briefly. So I started Amsterdam Investment Club and also Sophron, and the goal there is to build an international network for those who are interested in financial markets. So the goal is really to encourage people to build cool stuff together, share insights, and just share their passion for the financial markets. Nihar, if you can also shortly introduce yourself.
Yeah, hi, I am Nihar. My main goal here at Amsterdam Investment Club is to reach out to professionals, traders, and experts, such that we can get insights, because since quantitative research is a very changing field, it changes from year to year, and the books which have been written in like past 10 years may or may not help today. So our main goal is to get those knowledge from the experts right now.
And you, Arnav?
Yeah, hello. My name is Arnav Sathe. I'm the representative and founder from Prometheus Capital. That's a student investment fund here at the University of Amsterdam. So I founded it 2 years ago, and now I head all the quantitative operations for our team at Prometheus. But without further ado, we're going to go to the man of the hour, Johannes Muhle-Karbe. He's the head of mathematical finance at Imperial College London and the director of the CFM-Imperial Institute of Quantitative Finance. His research sits at the intersection of mathematical finance and real-world markets, focusing on topics like market microstructure, liquidity, transaction costs, and optimal execution. Before joining Imperial, he has a very impressive CV where he held faculty positions at Carnegie Mellon University, University of Michigan, and ETH Zürich, and is widely recognized for his work on how trading strategies perform in markets shaped by frictions and uncertainty. Welcome to the Sophron Network.
Yeah. Thank you so much.
It's a great initiative that you guys are running. Very happy to be here and have this chat with you.
No, we're really honored. And also today we wanted to cover some topics which are very interesting, both for people who are aspiring to become quants or traders, but also for people who are active in the industry. Because usually what you see from a theoretical perspective, markets are treated differently than when you're actually in the industry. So we really try to make a bit of a mix. I think also Arnav wants to introduce very shortly the first topic, and then we can also move to the first question. So the first topic is model misspecification and the P&L gradient of incorrect impact models. That's what we want to cover.
Yeah, so we just wanted to ask you to maybe simplify a little bit for the people in terms of, like, maybe not layman, but if you could just outline some of what these complicated words might mean for people on this podcast, as we are all learning. So if you could just graciously do that, please.
Yeah, maybe we start with the market impact, right? I mean, that's the thing we're talking about here. I mean, in very simple terms, that just means if you do a lot of buying, you push up the price, right? If you do a lot of selling, you push down the price, and then the prices at which you actually trade, they will be systematically worse than the prices that you see, right? And so if you run a big fund, you turn over large positions. This is kind of the main trading friction you have, right? As you scale your strategies more and more, there's a bigger and bigger share that you lose to these trading costs, right? And so that's why it's super important for any big fund to have a good model to kind of measure how big these costs are, and then think about how do you want to optimize the trading strategies that you run, so that you minimize the costs that you lose to these frictions, right? So that's the problem, right? Clearly, what in this line of research, what we're kind of looking at is, of course, these are models, right? And the models are wrong. Even if the model is good, you have to estimate it from data, right? And so there's a substantial risk that either the parameters are not estimated so well, or there are some structural problems with the model. And then what we want to understand is how much that matters. Is that something that on average, kind of averages out and doesn't play a very important role? Or is that something that you really should take into account when you design and when you estimate the models?
I mean, you said that let's start off with market impact, and that also plays very well for me, because my question was, many trading strategies assume a specific model of market impact when deciding how to quickly execute strategies or trades, right? So in simple terms, you've already touched up on what market impact is, but why is it so important for systemic trading strategy?
So the impact is important because if you don't take it into account appropriately, often it kills all the profits of the strategy that you're running. I mean, I think if you look at a lot of empirical papers from the finance literature where somebody designs some new trading strategy based on some new signals, and then very often in the end you have some super impressive performance metrics where it looks like the strategy is amazing and much better than what any typical hedge fund achieves in practice. And very often, one of the problems with this is that if you actually try to trade these strategies, very often the ones that look good on paper, they have a lot of turnover, they require a lot of trading. And so if you actually want to deploy a decent amount of capital, a lot of the profits get wiped out by the impact, right? And so that's why kind of incorporating that in the optimization is really a really key thing when you build any strategy that doesn't just run on a very small scale, right? And so why are the models so important, right? I mean, very often I get asked, why don't you just backtest it in the data, right? Why do we need the models? Why do we need to worry about estimating the models? And so I think with the market impact, without a model, there's just nothing you can do, right? Because all this optimization, this is about thinking, if I would have faster, what would have happened? If I would have traded faster, what would have happened, right? If I would have traded slower, what would have happened? But in the historical data, I only have the trades that I actually did, right? And so the only way to find out what actually happens is either run live experiments, right? Which are very expensive. And so before you do that, you want to have some model in which you can do some optimization, you can do some backtesting in this model, right? And then once that looks promising, you can go and really test this in some live trading experiments. So I think that's why impact is important, right? And really having some well-estimated model is really crucial.
Do you then also see that, because obviously you're looking at it from a very theoretical perspective, do you see that firms actually use this info directly when you publish a report, for example, on certain model specifications or misspecifications? Do you see that they start using that straight away? Or is it something where it's still rather technical and theoretical that they sort of lack that understanding? Or how do you see that?
So, I mean, this paper that we're talking about here, this grew out of joint research with Capital Fund Management. And so I think these questions, I mean, these models that we're talking about there, I think many companies use some variant of this, right? I think, I mean, how much they do the optimization in closed form, I don't know. I think that is not the key point, but I think fitting these models to data, I think that's something every systematic trading firm is dealing with, right? And so I think it's these insights, I suspect that some of the intuition, this is known to a lot of smart people doing this, right, kind of structurally. And I think this is the first paper that formalizes some of these insights in a proper analysis in the model, right? But I think that it's a big problem how you accurately estimate these models. I think if you talk to anyone doing execution research in a fund, they will tell you that, right? I mean, there's a bunch of people who say you shouldn't even bother with a model because there is so much uncertainty and it's so difficult to estimate anything that you shouldn't even bother with any model, right? And so I think dealing with the statistics issue, I think it's really a first order problem in practice, right? And I think in academic, I would say it's more the other way around, that in academic research, I think this has not featured as prominently as it should. So I think availability of good data is a big problem. That's, I think, the reason we could do this in this paper was because CFM allowed us to use some of their data. Right?
Okay.
So this information about what large orders were traded at what time, as a researcher with a public database, you normally just don't have access to that information, right? And so I think that's why I think this is a very valuable project that kind of bridges some academic research with a real practical problem.
In general, what do you look at when, for example, capital fund management comes to you and they say, hey, we want to look at our strategies and also the execution? What are some of the core things that you see which are usually misspecified, or also based on your research, where firms usually lack the sort of theoretical understanding, or where you usually improve things?
When is all this stuff important? Right? It's important if you have a strategy that trades a lot. Right? If you have some more or less passive strategy that doesn't do a lot of adjustments, right, or that's using some signals with very slow turnover, then all of this is pretty unimportant, right? I mean, then you don't have enough trading that the trading costs are really important, right? I think the other regime where it's not so important is if you have some strategy that has such a weak signal, there's so much uncertainty about what is actually the strategy that you're using, right? Then again, the uncertainty about that is so much larger than all the price impact stuff. That's just a relatively minor adjustment. I think where this stuff that we're dealing with here, it becomes really important is if you actually have a really good systematic strategy, right, that is well estimated based on some good signals that you discovered, right, so that you're reasonably confident that your strategy actually works well, right, and then how well you implement it and how much you boost due to impact, that often becomes the first order thing that you can adjust, right? So this is not for some weak plain vanilla strategy, right? I mean, then you have to worry about other stuff. But if the strategy is very good, then you want to wonder about this, right? And so then in terms of what is the misspecification you should worry about, I think kind of the punchline of this research is that, I mean, if you do statistics and you fit models, I don't know, you run some linear regression, right? What we're all used to is minimizing some least square fit of our models, right? And so we kind of used to thinking, if I'm too high or too low, it's kind of a very symmetric thing, right? And I just want to get it right on average. But in these optimal trading problems, often the P&L is very asymmetric, right? And so getting it wrong in a direction that makes you too aggressive, that often hurts a lot more than getting it wrong in the direction where you are not aggressive enough. Right? So, for example, I mean, if you have a very simple impact model, the only thing you're trying to estimate is if impact is small or large. Right? And imagine you estimate the impact is much, much larger than it actually is. Right? Then kind of the worst thing that can happen is you say this market is too illiquid to run my strategy, right? And I will just go away and do something else. Right? So in the worst case, you miss out on some opportunities, but it's not gonna be worse than that. Right? But imagine the opposite thing happens, right? You run your estimator and you are much too optimistic, right? You think you have some market which is super liquid, but it's actually not, right? And then you start running your strategy, you do an awful lot of trading, right? Because you think this is this super liquid market, but then you actually burn your money very quickly on the transaction, right? And so then very quickly you actually get negative P&L. Right, and so that's kind of, it illustrates this general principle, right? That getting it wrong in the conservative direction is not nearly as bad as getting it wrong in in the aggressive direction, right? And so if you have a more complicated model, it's more difficult to tell what this means, right? And in which direction you should worry about, right? But I think once you understand this basic principle, I think it's something that just makes 100% sense, right? And it's just where if you think about optimizing these trading problems, in the end, the goal functional really shouldn't be the statistical fit, right? But it really should be the goal functional that you're interested in optimizing, right? So something like the P&L or the risk-adjusted P&L, or something, right? So I think after you see that, you kind of know that this is the thing to watch out for.
Yeah. So
I had one more follow-up. Sorry. So you said that you keep gauging to the fact that it's sort of dependent on the person that's putting this to use, right? So, for example, a hedge fund manager or somebody who's developing strategies at a hedge fund. So, would you say that the learning curve is sort of dependent on the regime, or more so the goal of what your hedge fund actually is and where you're trying to capture your alpha from?
Yeah, I think it depends a lot on that, right? And so I think that if you talk to different practitioners, they worry about different things because they just run strategies on very different scales. So if you run a strategy that has relatively long-term forecasts, but executes orders intraday, right? This is a very different story from running a strategy where kind of the signals also move on the time scale of seconds or something like that, right? And kind of like how important the impact is, what are the biases that you have in the statistical estimation. Problems are very different depending on what time scales you are operating, right? And so I think that's, for example, like this study that we did, this is done on one particular set of CFM orders, right? That are based on some particular strategies that they traded in a particular way. But I think, there are some things that are universal, right? But I think from the anecdotal evidence that I have, it seems that this isn't one of them. So that I think if you have a different data set based on different strategies, I think some of the features will be the same, right? But quantitatively, others are quite different. I think that's why from the point of view of academic research, I think it really would be amazing if some more companies, exchanges, make some suitably anonymized data sets available, right? Because I think really a major bottleneck of academic research has been that it's very difficult to look at these data sets, right? And conversely, the people who do this in industry usually not allowed to share their insights with anyone, right? They're also not allowed to iterate with people in other companies, right? And so I think that has really been a major limiting factor in making progress on many of these problems.
In general, with these models, do you quickly run into, I don't know if you cover this, but do you quickly run into dimensionality issues because you're looking at especially for high frequency trading, when you're looking at a very short time frame? How do you deal with like these impact models if you have a lot of data?
This is a fundamental question, right? So I think like in many things, there are parametric approaches and there are non-parametric approaches, right? So for example, in this paper that you are referring to, we take some low dimensional parametric models that have maybe 2-3 parameters, and then if you fit this to a big data set of orders, that actually works reasonably well, right? If you look at the standard errors we report in the paper, I think you can. There are still significant errors, but I think that at least there aren't so many parameters, so you can say something with some confidence, right? But of course, in many cases, to kind of figure out what is the functional form that you want to use, you really want to run some non-parametric estimator. And that is much harder, right? And so I think, in particular, for example, for every small fund that is trying to train their impact models, availability of data is a huge issue, right? And of course, you can try to fit also to public data, right, or some combination of public data and your own data. But I think that is really a major challenge. How you can fit some more flexible model with the data sets that you have. And so yeah, no, I think it's a challenging problem. Yeah.
Moving to the second topic, which is Bayesian estimation of Sharpe ratios and the complexity haircut. So what you usually see is that performance metrics such as Sharpe ratio are widely used to evaluate investment strategies, and they often give an overly optimistic picture, either because they overfit the data or there is some bias involved where it makes the strategy look to be performing much better out of sample when it's actually not. And also looking at strong results from the backtest frequently results in having a sort of a misinterpretation of what you expect the models to do in the future. We want to look at your paper more regarding the replication ratio, because you also cover a ratio which compares the out of sample to the in of sample performance of various strategies. And we also know that for a lot of quants and traders, this ratio is very important, because obviously you always want to measure what's happening with their strategy in and out of sample, because you never know, of course, and you kind of want to gauge what's going to happen.
Yeah, so kind of the origin of that paper was that in practice, very often people use some rule of thumb, right? So I think one usually is to say you should haircut the in-sample Sharpe ratios by 50%, right? A rule, but then of course you think like if you have a more complex strategy or you trained on a larger data set, maybe something else should happen, right? And you kind of would like to have something that is based on the experience that you have with other strategies, but then if you have a new strategy, kind of takes into account at least some things you know about that one. Right? And so I think in the literature, I mean, there were a couple of really nice Bayesian papers that kind of try to do these things, that you try to start with some prior that you have about how these things typically work, right? And then as new data comes in, you update the prior and you kind of refine what you know about your strategy, right? And so the new bit in this paper is that we try to fit this in a way where we don't just look at in-sample performance, but we kind of look at the big data set of hedge fund strategies, right? Before they were launched and after they were launched, and kind of for all these other strategies, you can see how much worse the performance became after they were launched, right? And they really ran out of sample. And so then you can try to fit the joint Bayesian model that kind of looks at what happens in sample and what happens out of sample, right? And then after you train the model on this, you can actually run this for a particular strategy and then kind of make forecasts how well you think that one is going to perform, right? So it's kind of, you start with what you learned for many other similar strategies, right? But then if you want to look at a specific new strategy, you look at the data for that one and you kind of use that to update the product that you have from other strategies.
So then moving back to also the sort of dimensionality issue and also the sort of reliability of this ratio, can you say a bit more about what happens between this gap between in and out of sample when, for example, you start to use way more predictors in the model? Because previously you were talking about a very simple model, but what happens if, especially now these days with, for example, machine learning, or there's way more data that these firms have? Can you tell us a little bit more about what happens there when there's more complexity?
I think that the general issue is that if you have a very complex model and you give yourself a freedom to fit all the parameters, then usually this issue of overfitting, it becomes much more severe, right? So this is like if you study this in some toy regression model with plenty of parameters, I mean, very quickly just get a disaster, right? And that's why nobody would apply a model that naively, right? I mean, then usually you make some structural assumptions, right? That instead of an unconstrained regression, you run some panel regression where similar factors have a similar impact on different assets, for example, right? And you kind of try to put some structure that reduces the dimensionality, right? So, I mean, of course, you're alluding to kind of modern machine learning models, right? And so in a way, these are much, much more complex, right?
Mm-hmm.
So why is there any chance that this can work, right? And so I think one answer is that very often you don't actually train the whole model, right? So very often you have these models which have some random features where kind of a lot of the parameters, they are actually not trained, but they are just sampled randomly, right? And then, for example, often you only train the last layer, right? And so then, of course, you have a chance that a lot of this effective complexity, it's actually not optimized, right? But it just gives you a richer set of features on which you can do your training, right? So I think this is one point. I think then another point is that to avoid overfitting, the standard approach is to regularize your regression, right? If you run a regression, if you run some other fitting, and you want to say, okay, I allow myself to have a rich class of features, right? But then I only want to pick the ones that really matter, right? And so I think this is another standard approach, right? So either whether you explicitly you put some regularization, or you have some implicit regularization, which many of these training methods for neural networks induce, for example. Then again, you have some features that say, well, I don't actually freely choose all the parameters I want, but I put something in there that robustifies this, right? And that only lets me use a super complex model if it actually has a chance to work on a sample, right? But I think it's a super key current research topic, right? That understanding how these models, these high-dimensional complex models, how well they actually work, how well they generalize. There's a lot of anecdotal evidence where people have tried these for different problems, right? There are some toy models where one can understand some things, right? So there are these much discussed virtue of complexity papers, for example, right, where you can have some simple settings where actually you can do math to understand some of these effects, right? But then in the end, these are still basically linear regression models in which you can analyze some of the effects, right? And in any of the real nonlinear neural network models trained with stochastic descent, we are still only at the very beginning of understanding how exactly that stuff actually works. But I think these are super key questions, right? But we are quite far away from understanding that. And so I think that's why the second paper that you are referring to, this Bayesian paper, so that tries to go away from a specific model, right? So you don't want to write a model for how the strategies were produced, right? Because in many cases, you just have no idea how people actually did that. Right? So imagine you are in the central team of some hedge fund, and the different pods, they show some strategies that they somehow came up with, right? But then you have no idea what was the research process. You have no idea how many things they tried. If it's a neural network, you have no idea how they trained it, right? And then you kind of need some method that is agnostic to this construction, right? But it still allows you to say, how much should you haircut the strategy, right? I mean, how conservative should you?
All right. And I think also Nihar had one more, a bit more technical question.
For my listeners, I will translate this question into layman words such that each one can connect into this. So I asked that your Bayesian framework was built assuming signals are independent, but real markets have memory. When trading signals cluster and persist like order flow, does your model quietly sees far less data than it thinks? Your out of sample PNL swings wider than you predicted, and your complexity haircut? How many strategies you can safely run which are swing dramatically? So when signals become strongly autocorrelated and approaches near critical persistence, does your entire framework actually breaks down completely, and then there is a point where no amount of Bayesian correlation can save a high dimensional systematic strategy? So
Yeah.
Okay.
I think before that, we can maybe do a bit of a intro in general to the second topic.
Maybe just to to start, right? So this is about a different paper, right? So this is not this is not about market impact, right? I think this is about a related problem that makes out of sample performance much worse than in sample, right? So this is if you fit models in sample, your in sample performance usually is really good, right? But then if you run it out of sample, it's much worse, right? And so the paper Mihar is referring to, I mean, it looks at one simple example for this, where you have some relatively simple linear regression model, you fit in sample, right? And then you kind of want to make predictions how much worse this is going to perform out of sample, right? And so kind of to do the math and to get some relatively tractable formulas, I mean, kind of the baseline setting that we study is where the signals are IID, right? So it's kind of like where every trading round you get a new trading signal, and then the next near trading round you get a new draw from the same distribution, right? So I think in the end, that's just an assumption to make the math tractable, right? So I totally agree with you that many signals are not like that, right? If you take something like a momentum signal that clearly is autocorrelated over time, I don't know what often people use in the finance literature, something like price dividend yield or something like that, also is very strongly autocorrelated. And so I think that's why in the paper we have some numerical robustness checks where we say, what if we take some of these signals that people have estimated from the data, and then we just apply the formulas from the paper that were derived with this IID assumption, and we see to what extent do the results still hold, right? And so I think then what we find there is that kind of in absolute terms, things change a fair amount, right? But if you look at this replication ratio, what percentage of performance you actually lose out of sample, then this still works pretty well, even if the signals are pretty persistent, right? And so I think that's what makes the result useful, that in many practical settings, the autocorrelation is not so strong that these formulas we derive using the IIC assumption, they are still useful. So I think if you go to the opposite extreme, where you have super strong autocorrelation of the signal, right? I mean, then it's almost like the thing doesn't move over time, right? And that's clearly a very different regime. And that is studied by another paper, right? So that specifically looks at this case where trading opportunities don't move over time, right? And that one you can also work out, right? And so I think if you have a very strongly autocorrelated signal, you should just turn to this paper by Kahn and co-authors, right? And if you have something where the autocorrelation is not that strong, then I think our paper works better. And so kind of like these two limiting cases you can do analytically, and then the reality is somewhere in between.
Yeah.
So now that you've sort of covered the Bayesian inferences and the statistics behind it, and also we've talked a bit more about the academic or like contributing to the academic debate from a practical perspective, we'd like to move on to the third segment, which is the efficiency frontier of linear approximations for power law impact. Now, for the listeners, market impact is widely observed to follow a nonlinear relationship with trade size. So often approximated by a square root law, for example. Now, in theory, this suggests that optimal trading strategies should also be nonlinear and potentially quite complex. However, complex execution models can be difficult to implement in real trading systems, and I think you can agree with this, yes? So in this section, we would like to discuss research showing that relatively simple linear trading strategies can perform surprisingly close to the true nonlinear optimum. So offering an important practical insight for traders designing execution algorithms, right? So Professor, if you could quickly just give a bit of context to the listeners regarding what this paper talks about, and then after that, we can maybe start asking you a couple of questions.
Yeah, so I think you already summarized the main problem quite well, right? So I think, if you're an applied mathematician and you like to write down models that you can solve analytically, right? We like linear models, we like linear quadratic controlling, then you can do explicit computations, and then that works well as a mathematician, right? And so I think market impact is an interesting phenomenon because it's one of these things that just isn't that well approximated by a linear model, right? I mean, maybe locally, yes, but as you execute a big order, exactly as you were saying, there just is a nonlinear effect on the price, right? And so these models, there are some very simple cases where you can compute something, but very quickly you hit a wall, and there just aren't any simple tractable results, right? And then of course nowadays you can go to the computer and you can run some non-parametric reinforcement learning method, and you can try and get something out of that, right? But then it's not clear, does that work, right? And if it works, what are actually the features of this thing, right? And is what you discover, are there some genuinely new insights in how you should trade, right? Or is it more or less the same as what you know from simple models?
Mm-hmm.
Mm-hmm. I think kind of in this paper, the idea was to say, look, we try to do something much simpler, right? We don't try to solve this complicated model, right? But we just take some very simple parametric class of strategies, right? So think of it as a neural network for dummies, right? Where instead of a real neural network, you have a linear function with one or two parameters,
Mm-hmm.
right? And then exactly as you would train a neural network, you just optimize over these two parameters, right? Of course, you don't need some fancy method. You can just run a grid search, right? And then you just take the best strategy in this very simple class, right? And you compare to some non-parametric machine learning solution, and you see how much worse you actually do with a simple strategy. And so kind of the outcome of this is that very often the difference is actually surprisingly small. And in particular, the differences are very small compared to the estimation errors you have for these models. And so I think, yeah, kind of the takeaway is that at least in the examples that we looked at, it would be very hard to justify going to some black box numerical optimization when in the end you actually only get very small outperformance. I don't think it's a very key point that I often get asked about, right? Does this mean that the nonlinearity doesn't matter, right? And all we need are the linear models? And the answer is no. Right? So it's very important that these linear strategies, you need to train them in the right nonlinear model, right? And you don't use the linear strategy that is optimal for a linear impact model, right? That's what we tried first, and that's pretty terrible, right? It's important to do the statistics correctly, right? And so kind of to estimate the right nonlinear effects that you have in the data. But then on the optimization side, you can actually get away with surprisingly simple things where some really simple class of training strategies can do almost as well as the optimum, right? And I mean, my background is in stochastic optimization, optimal control, right? And it in a way, it really hurts me to say this, right? But I think the statistics of some of these models actually seem to play a much bigger role than the optimization in many contexts, right? That on the optimization side, the surface is relatively flat, right? And you can run different strategies. You can approximate with simpler strategies, and you can still do pretty well, right? But if you kind of get the model wrong, then you problem, right? And so I think that's more broadly, I think both the first paper we started talking about and the last paper we're talking about now, I think they both point a little bit in that direction. Right? In this tech space is that we really need better insight in how to do the statistics, better insight in how you incorporate these statistical methods into the optimization, right? How you build the right statistical routine into the optimization, right? And then if you want to look forward, if you actually want to test the strategies, right? I was saying you want to do this live trading experiments, right? And then the question becomes, how should you do that? Right? What are the right experiments you should run so that you remove the biases in your statistics as quickly as possible, right? And again, I think there's only very few academic papers that look at that. And I think there's a lot of experimentation in industry, but on the academic side, I very much hope that we'll see more of that in the next couple of years. Right? And so I think this is where tech and machine learning, I think, kind of ahead of the curve for finance a little bit. Right? So I think, for example, there are these Netflix papers that got a lot of attention about doing systematic experiments and how you display ads to users, right? And I think the same kind of questions, they appear everywhere in market microstructure, right? And I think we really need to think about that.
Do you think there is ever a sort of optimal algorithm or an optimal sort of model that can truly capture also all the irregularities in the market? Because I think in general, like, it's still humans who are trading, or now it's computers a lot, but it's still firms competing against each other. Like, do you think, like, what are sort of the core pillars that academia should focus on? Like, where do you think the most value is still captured? Is that really the impact side?
That's a very good question.
This sounds like a personal question for Vincent's portfolio. Huh?
I thought the first question is almost like asking me whether I believe God exists or something like that. I think, I don't know if I have a good answer for that. I think there are some surprising regularities in market, right? So I think we talked about the square root law, right? So I think, for example, there's this whole discussion about rough volatility. I think that's another surprising regularity that is surprisingly ubiquitous in different contexts, right? I've done some recent work with Mathieu Rosenbaum and some of his collaborators that try to connect some of these things, and they do fit together in surprising ways, right? But I still think, finance still is not physics, right? I think there are some things we can understand and there are some things we can model, right? And but then there are many other things we don't understand and we cannot model. There are also many things that just change over time, right? Which in other fields you don't have, right? And so I think, being humble and acknowledging what we don't know is a very important thing.
So do you think there's still a lot to discover sort of in these market impact models and these misspecifications? Do you think there's still sort of many things that you can look into that can be optimized?
Yeah, I think that's, in a way, to me, that's a surprising thing that it has been a topic of intensive research for a long time, but I think still there are so many very basic things we don't understand. Often the data is the bottleneck. Often the bottleneck is that academics don't talk to practitioners enough and vice versa. And I think a lot. So I mean, I think just as another example for a whole different research agenda in this context is, I mean, that almost all the empirical papers about market impact look only at equities. I imagine I have done some work on foreign exchange, right, which is another equally super liquid market. And then you get asked by the referees, why don't you cite some empirical papers that actually estimate market impact models for FX? Yeah. And then there almost aren't any, right? So I think we started doing a little bit of stuff in that space, but it's only scratching the surface, right? And there's a reason for that, right? These markets are much more complicated. There is no national best bid offer price, right? They are fragmented across with bilateral trading between clients and dealers, right? And it's difficult to kind of accurately measure these things, right? But at the same time, it's a super important problem, right? How do you deal with this? What is different from equities? What is the same, right? Then FX is still well understood relative to fixed income, right? Yeah. All these very fragmented trading things where there are thousands of bonds, which rarely ever trade, but of course they are all kind of tightly related. So how do you write some impact model for that, right? How do you deal with that? So I think on some very fundamental model level, there are many more things that need to be done, right? And I think I think, I think, the way to do it is, I think, to foster more of this dialogue between people in industry who have the right data and who have the right institutional knowledge how many of these things work, right? And then academics who have kind of the time and the freedom to think deeply about how one should approach some of these things. I think that's the way to make more progress on many of these problems.
Yeah, like before we finish, I have like one last question. Like my question is that what topic are you researching right now and why? And in continuation, my other question is what other laser sharp three domains you can feel that in future that these by doing research in this can be a great thing and why?
Good question.
Yeah, now he's going to disclose all of the secret information that.
Yeah, exactly.
No, it's just a general view, like.
Yeah, good question. So I think if you want to ask me what is the most fascinating research project that I touched recently.
No, what project are you working right now in general ways? Like, okay, I'm like, and I think, and why you are working on it. So we can understand the motivation and we can also connect with and we can understand all those things.
Yeah, no, I mean, I was going to say there are different things that I'm interested in, right? We touched on some of the stuff today, right? And I'm continuing to work on many of these things, right? But I think maybe let me use the opportunity to make some more advertisement for this recent work on connecting different things, right? So that you have this almost physics-like paper about different empirical regularities, right? We talked about the square root law, mentioned the rough volatility, and then there are more regularities like that where people have measured how you should model order flow, right? How you should measure model trading volume, how you should model prices, right? And so I think we have been working on this unified framework that kind of tries to fit all of these pieces together. Right? And so I think in a way, it's almost a physics paper, right? Like in these questions you were asking about, really, what is the general mechanism that connects some of these things together, right? And I think this paper has gone surprisingly far in that direction, right? And so I think it's less clear what is the actionable item that maybe you have with some of the other things we touched upon today, right? But I think if you want to think about how do markets work, how do they process the orders that come in, how are the orders transmitted into the prices, right? How does that all fits together? I think this is really a super fascinating piece of work that we just put out, right? And that hopefully is the beginning of understanding some more things in that context, right? But I think this is one particular example. I think there are many other things, right? And hopefully there will be many more interesting things to discuss.
So last question, like what three specific, like 5 to 10 words topic would you say like that people, why are not focusing on these three topics? Because you are feeling that these three topics will boom in future, but people are just ignoring it right now. But you have a great feeling, this work will have great impact in future of finance. So what three topics will be?
Okay, that's another tough question. So I mean, I think one of the clear things that everybody is talking about and everybody is thinking about, for example, among everybody I know, I haven't seen any convincing paper so far, are all these very latest developments of, I don't know, large language models, agentic AI and whatnot. Right, so I think it's not that people aren't interested in that. I think everybody is interested in that. Nobody has any good grasp yet what is going to be the long-term impact, right? But I think the reason there aren't any good papers yet is that in finance, I mean, we have a little bit this paradoxical situation that on the one hand, maybe many things can be automated and many things will change completely, right? But if you think about for which problems we really already have a fundamentally different solution, then there aren't actually so many good examples, right? I mean, like I gave this example of these nonlinear impact models, right, where in principle you have the technology now to run these non-parametric machine learning models.
Yeah.
Then you look at these examples, they don't actually work so much better than something really simple, right? And I think on the one hand, there are many examples like this, right, where people have tried really hard to get better results with some of these modern models, but then often it really isn't so easy, right? At the same time, in many other fields, it was like that too, and then at some point you flip the switch, these learning models suddenly outperform everything.
Yeah.
And there were many fields where people said kind of like, this is really different and this is not going to work, and then it did, right? And so I think at finance, the jury is still out, right? And I think I don't have the answer to that. I think if you want one keyword, I mean, we will at least get some more answers in the next couple of years. I think clearly everybody is thinking about that. I'm thinking about it. Everybody else is thinking about it. And hopefully we will get some new insights, right? But I think it's really a fascinating point and something that I've never seen before with any other field, right? Where kind of, at the one hand, there's the promise of what things can be done, right? And on the other hand, there is what actually has been delivered. And in finance, I still see a big divide, right? And we'll be interesting to see what happens with that.
We were previously talking to, on one of the episodes, Professor Jean-Philippe Bouchot from CFM actually as well. He was talking a bit about how physicists are moving into the field of finance, specifically quantitative finance, quite heavily, because there they find it much easier to sort of go from contributing to the academic debate and finding ways to put what they've sort of contributed to that academic debate into real world finance. So here, what you're saying, sort of, at least from what I've gauged, is that both sides should equally contribute to sort of that one goal of making sense of quite an arbitrary domain, right? Or when I say arbitrary, I mean ever expanding and quite dark domain, in the sense that there's really no way for you to see far ahead without actually working towards building the stepping stones to move and further the progress.
Yeah, I mean, I think for this conference that we run together with CFM, kind of the guiding theme is confronting many viewpoints.
Yeah.
I think in general, that's the right way to approach these hard problems, right? That if everybody who looks at the problem kind of has a similar background, has a similar way to approach different problems, I think that's not the way to make progress, right? But I think if you have people with a different perspective who look at this, I think that's the way.
Okay. And just very, very shortly, I don't know if you have 5 minutes, but I wanted to ask, as like a last question, what was your most sort of mind-blowing moment where, for example, you have the square root law or some things that are sort of similar to physics, but what was like your sort of crazy mind-blowing moment that you realized, oh, it's actually way different than I expected, or there are similarities?
Yeah, I mentioned this paper, this unified theory we have been working on, right? So I mean, that started out kind of like, on a much smaller scale, right? You think like you want to have certain behavior of the order flow, you want something like the square root law. How does that fit together, right? And then I think this grew and grew. We had some theoretical model. The theoretical model made some predictions, right? And then you think, this is some little toy model. This can never work, right? But then you separately test each of the predictions of the model, and it actually does seem to work remarkably well.
Yeah,
I think that is something that has never happened to me before in this, right? And so I think that's.
So now you're just building one giant model that's...
But I think that is the biggest Oracle moment I have had so far.
Yeah, so I think now you're just building one giant model that understands the whole market.
No. I mean, I think that is clearly not the goal, right? I think I think this model it tries to explain how certain things fit together. Right? It's not claiming to understand and predict anything about markets. Right? I think this is much more. You have certain scaling laws in certain different things, right? And kind of really in this tradition of what people in econophysics have been doing for a long time, right? You kind of try to connect this and fit this together, but that's not gonna predict anything about how markets will evolve or how prices will change, right? And we make no claims to that.
No, but I think it's a very important part of the market because that's also where eventually you try to understand the order flows and how the sort of execution models work and the impact and how it works when you're actually trading. So I think it's very valuable if you have a model where you understand and can link together some of those components. But I think that's also time from our side, and we don't want to hold you up for too long.
No.
I think also, Arnav, anything you want to say, or Nihar?
No, I just wanted to just thank you for the time, specifically because now we've had previously Jean-Philippe Bouchot from CFM, and then now who also worked with CFM, I guess, alongside your research, and you're going to conferences alongside your like very deeply rooted academic background. It was very interesting to see how the econophysics academic debate has further progressed also through your work and through the work of Professor Bouchot. So, it was just, more and more so. Thank you so much for an hour and some change of your time today, and hopefully get to talk soon in the future.
Yeah.
Thanks a lot.
Yeah.
Absolute pleasure.
Yeah, same thing from my end. Like you spent 1 hour with us, and the 1 hour was a golden opportunity for us to understand everything around it is happening in the financial markets. And thank you for supporting our mission to provide quantitative finance at reasonable cost to every student around the world. Thank you.
Yeah. Thank you so much. We really appreciate it. And it's also starting to all make sense now how everything is connected, at least to some extent. We still know how much of a gap there is for us to that we don't understand anything, but it's also good to know that we don't understand anything. So but it's super interesting, and we were very glad that you could join today, so thank you.
My pleasure.
Yeah.
Right.
Yeah, and just one last question. Like one just it's like a very fairy tale question. Like, if you got like one more life, will you spend in this domain only, or you will spend elsewhere?
I'm very happy with the life that I have.
Yeah, DR is always asking that. No, thank you so much. But we really appreciate that. And also Nihar has been asking all the spiritual questions, but I think it's good to hear. So thank you.
Yeah.
Right.
Thank you, sir.
To meet you guys.
Bye.
Bye
Bye bye.
Bye.
All right. That's
Nice.
Yeah. We have one more podcast on March 18th, and the time is like around just a minute. Let me see exact time.
I love how Nihar is just, it looks like he's in heaven because he's wearing he has the blue background and like the blue shirt, and it just looks like you're floating and like you're skydiving, or like you're in heaven, like the god of all quants has spawned in. It also looks like, Arnav, that you're very smart right now because you got all the papers in the background and then you're blending in. You guys are the only ones. I'm the only one that's not blending in with my background today. Like, what the? I'm literally. You guys are like perfectly. Like, let me change my. Wait, let me.
You gotta change your background.
Yo guys,
I'm
in my mansion.
I'm loving this.
This is not CGI. It's actually like, look, I have like the.
Vincent, you look like you're about to get like killed.
Guys, I'm in my mansion and I have like big ass plants here.
Wait, so Nihar, how long are you gonna be done?
Look, this is my
Nihar's
bone,
frozen.
right?
That's wire. also like eating cookies for these like the end of the clips. Like I'm
No,
fucking.
but that's okay, because like Nihar is frozen. It looks like he's the
Yeah.
god. He's like so aesthetic right now.
He looks like he's on a beach, bro.
So we ended at 3. Yeah, there we go.
Yeah.